Hello, 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 and welcome to another episode of She Talks Business. I have to tell you, I am really enjoying this season on all things related to money. And we've got some really interesting guests coming up too. Michelle Bosch, who is a colleague of mine, is going to join me during this season. And we are going to talk to you about what you can do to invest your money to make more money. So stay tuned. That's going to be a really, really, really powerful show. But today, I want to talk to you about some of the nitty gritty stuff that I know many of you probably don't do. And you probably don't do it because no one has ever taught you how, and therefore you shy away from it. And you probably, I'm going to hazard a guess, feel dumb when it comes to this because no one has ever shown you how to do it. And I want you to know as you listen to this episode that everything that I am talking about is a skill that is learnable. It is not something you are not capable of doing. It is something you are very capable of doing and something that you should be doing as you move your business forward. Your role as the founder and CEO of your company is to ensure the financial health of your business. And you can't do that if you don't get comfortable with money and metrics and understanding the financial ins and outs of how to run a business. So today's topic, this episode is all about how to forecast and budget for your business finances. So I am going to walk you through, I've got some notes here that I'm going to follow. I am going to walk you through 9 things that are super important for you to think about. And pretty much they are in the right order too. So as you listen to this, try not to jump around. They're kind of foundational. You need to set a goal before you look at your data, your historical data, and before you start estimating or forecasting. So it's important that you don't think that this stuff just all happens automatically. There is a process that you want to follow. So number 1 is you do want to set some really clear goals. You need to start by defining your business goals and objectives. Too many business owners get to the end of the year and they find out that the profit they have or they don't have is a big surprise. And it's a surprise because they haven't defined their business goals and objectives. They don't know what the measurements of success should look like because they haven't been intentional about them in the beginning. When I am planning for my business, I'm always very clear about the fact that I want a 30 to 40% profit margin. I want to land around 30% every single year. And so everything that I do when it comes to pricing keeps that in mind so that I'm knowledgeable enough to price the right way. And I'm pretty sure we have a previous episode that's on pricing for profit that you can take a look at if you haven't listened to it before. But it's important that you start by defining what your business goals and objectives are. How much do you want to sell and how much do you want to make in profit? And it's also important that you quantify what does that profit mean? So if I sell $1 million, if I generate $1 million in sales, and I want my profit margin to be 300,000, 30%. Does that 300,000 include my salary or is that 300,000 after salaries? There's no right or wrong. You have to decide. So let's just say hypothetically that I pay myself $100,000 a year. Well, if I pay myself $100,000 a year, then will I be happy if I have a profit margin of 200,000? So 200 plus 100 equals 300. Or am I expecting to pay myself 100,000 and generate 300,000? It's an important distinction because one is essentially ensuring that you as the founder have 30% in your pocket. The other is 40% in your pocket. And I'm just using those numbers loosely. It's not because the numbers are right or wrong. It's just simple math. But if you don't know how much profit you want, inclusive or exclusive of how much you pay yourself, then it's going to be really hard for you to forecast and budget for your business. So it starts by getting clear about what your business goals and objectives are. So when you think about your business goals and objectives, there are some things you want to take into consideration. 1, what are your revenue targets? How much do you actually want to generate in sales? What are your profit margins? And the reason that they should be a margin and not just a fixed amount is because if you do $500,000 in sales versus $1 million in sales versus 100,000 in sales, the variable should be a profit percentage, not a dollar amount. You can't really make $100,000 in profit if you only do $100,000 in sales. But if you do $500,000 in sales and you have a profit margin of 20%, you can generate $100,000 in profit. Or if you do $300,000 in sales and you have a profit margin of 30%, you can do that. So you need to be clear on what that margin is. And you also want to be clear on any other financial benchmarks that you want to achieve. So for me, another financial benchmark that is important to me is cash flow. I want to know what cash in bank looks like by the end of every year. That is a goal that I will set. And the reason that I do that is because the amount of money that you keep in your bank account, in your cash flow, directly lands on your balance sheet and it impacts the valuation of your company. So it's not just about the profit, but it's also about the money that you have in hand. So those are targets that I like to consider. You need to think about what matters and what is important to you in your business. When you have really clear goals, those goals should provide you with the direction and intentionality to then forecast and budget and do all of the things that you need to do accordingly. But if you don't know where you want to end up, that's like getting into a car and going on a trip and not knowing how much fuel you need to get there, not knowing what the distance is like. You have to know when you're starting out what you would like to achieve. Now, here's something I also want to talk about. Sometimes when you're setting goals, you're thinking about what you'd like it to look like in 5 years. Maybe it's not going to look like that in 5 years. Maybe your goal is to get from, 20,000 to $1 million. That's a great goal to have, but you're likely not going to reach $1 million in your first year. So it's important that when you are setting clear goals, that you're setting goals that are achievable each year that you're operating in. You don't want to set the goal so high that you then budget and spend money on your expenses that is unreasonable because you don't have the revenues to actually pay for those things. So it's really important that you right size your goals for each year. And that's where point number 2 comes into play, which is review historical data. I cannot stress enough how important reviewing historical data is. When you interview somebody, there's an expression that past performance indicates future performance. It's the same when it comes to numbers. You really want to analyze your historical data, the financial data in your business, to identify patterns, trends, and seasonality. So if, for example, you are a retailer, I have a client who owns one of the nicest floral shops in Ottawa, Flowers Talk Tivoli. She's amazing. She's got to look at the trends in her business because, Valentine's Day, Mother's Day, Easter, Christmas, those are all seasons where sales are really high. But if she looked at Valentine's Day and then planned that her sales were going to be the exact same every week of the year as they are the week of Valentine's Day, she'd be delusional because seasonality has a great impact on her business. So do you know whether you have a seasonality impact? The only way you know is to look at month over month data for a year and then look at the same data month over month, year over year. So compare January of 2022 to January of 2021 to January of 2020. If you don't have that much data, then track what you have now. But it's important that you look at how you have done during the same period of time on a multi-year view, if you can, so that you can identify what those patterns and trends look like. When you review your historical data that way, it helps you to make better decisions. This helps you greatly understand past performance so that you can make better informed projections for the future. So when you are analyzing your historical data, don't look at just sales. Also look at historical expenses. Pull out your P&Ls for every month of the year and write it all out. How much did you generate in sales and how much did you spend? Because when you start looking at those financial benchmarks, it makes it a lot easier for you to then predict how much you may need to spend this year and maybe even identify places where you can cut back. You want to look at sales, you want to look at expenses, you want to look at cash flow and any other relevant metrics in your business. So when I do this, I have a spreadsheet that has sales across the top, and then I have wage costs as a second line. And then I have operational costs, which is everything else. And then I have profit. And then I have profit margin. And the reason that I look at it that way is I want to understand what are my people costs versus my operational costs, because people costs, in a lot of cases, they're a fixed cost. Some of your operational costs are fixed too, but I want to know, where am I too fat or where am I too lean? Where am I spending too much money? Where am I not spending enough? And when you look at those numbers and you look at them on a multi-year basis, month over month, you can identify where there are outliers that don't make sense. The other thing that's a good idea for you to look at when it comes to historical data is to look at your lead sources. So where do your sales come from? When you do this, it helps you to then know what marketing activities drive sales. When you do this with historical data, it's factual versus going by gut instinct. When I ask people, where do your leads come from? They're like, oh, well, some come through my website, some come from referrals, some come from social media. Some isn't data. It's this nebulous, vague thing. It doesn't help you decide where to put more efforts in. So if you have the historical data and you can look at every single customer who buys from you and you have an actual lead source of where they came from, that historical data will help you to know where to step on the gas when you need to generate more sales. So I know, for example, when I attend events, when I go to other people's events, when I host my own events, and anytime I'm speaking, it's a really, really great lead source for me. So it's important that I carve out time in my business on a regular basis to do that, because I know that that's where a lot of my business comes from. But do you know if you were to actually take your customers and you were to go through them one by one, do you have the historical data to actually know where your business comes from? That's really important when it comes to planning your marketing to help you drive your sales. All right. Speaking of driving sales, number 3, you need to get good at estimating your sales. You need to be able to estimate what your revenue, or forecast what your revenue is going to be like for the upcoming year. When you are forecasting your revenue, you want to consider things like market demand, pricing strategies, how many people you have in your sales pipeline, and you want to look at your historical sales data. Because when you look at those things, it helps you to be able to actually predict what sales you can expect to have happen in your business. So I love recurring revenue. It's one of the things that I've built my business on. I can predict when renewals will take place, and I have the data that helps me to predict what percentage of people will continue to do business with us. And so because I have all of that, I can forecast in a spreadsheet on a customer basis, line by line, how much revenue is already booked for the year. That doesn't mean it's guaranteed. There's always going to be changes, but there's a heck of a lot more confidence that comes into planning when you can estimate with a certain percentage of accuracy how you're going to end up for the year based on the trends that you've looked at with your customers in the past. So get a spreadsheet and map out any revenue that is recurring, whether it's recurring on an annual basis or on a monthly basis, to give you a 12-month baseline of where you will land if you keep your existing customer base. When you're able to do that, then you can actually see what you need to do in terms of an incremental growth. If you're looking at your business and you think you're starting from 0 to 1 million, but really you have 700,000 booked in business, you're not looking at it the right way. So get clear on what revenue is likely to remain consistent for the rest of your year. You also want to take into consideration any anticipated changes. These could be changes in your market, changes in your business capacity, changes in your industry, or even changes to your client base. So you may have a client relationship that's a little bit stressful. You may want to take that into consideration, that maybe they won't stay for a long time. You may have a client that's trying to exit their business. Their business is for sale. You probably want to plan for that client to leave. It's important that you are looking into the future and you're making some predictions about where change may come from so that you can, again, amp up your marketing and do whatever you need to do to generate the business to keep your business going should some of those things happen. I think it's also important for you to be realistic and also consider potential growth opportunities. So in your business, you only have a certain capacity to fulfill a certain number of customer orders and requests. Most businesses have a max capacity, and that capacity can be expanded or it can be contracted based on the number of people that work on your team or the number of hours you're willing to work. So it's important that when you're considering your growth opportunities, you're also considering your capacity. If I wanted to double my business right now, I could probably ramp up the marketing to double the business, but my capacity would suffer because I could not ramp up double the size team fast enough to support double the size business this year. So if I wanted to double my business, I would need to start ramping up now and look at that as a 24-month plan versus a 12-month plan. This is what estimating revenue and reviewing historical data and projecting expenses allows you to be able to do. All right, number 4. The fourth thing you want to do is you do want to be able to project your expenses. You as a business owner need to know how much it costs to run this business of yours. So you need to be able to identify and estimate all of your business expenses. It's a really good idea to know what your fixed costs are versus your variable costs. So fixed costs are things like rent, utilities, salaries. They're the things that you pay for every single month or every week. They just happen automatically. Whereas variable costs might be certain aspects of your tech stack. It might be your marketing budget. It might be supplies. If you are a retailer, it could be cost of goods, how much inventory you order. So know what the difference is, because when you are planning for profitability, you need to be able to take a really good look at your estimated revenue, and you need to subtract what your projected expenses are. And the first line you really want to look at is what those fixed expenses are, because they're the most important. You can't really control them. When they're fixed, it's like your mortgage payment, right? Your mortgage payment is what your mortgage payment is, unless you go to the bank and you renegotiate and lower your rate. You need to take those things into consideration when you're planning. Otherwise, you can run out of money. Same thing as when you are looking at your sales, you want to review historical data for your expenses, and you want to consider any upcoming changes or cost-saving measures that you want to implement. So in 2022, I was on a mission to eliminate unnecessary costs. And we were looking really, really closely at our tech costs, our SaaS costs, because over the years, a lot of these costs had crept up. And so we were looking for other service providers or solutions that would be more cost-effective, but would still offer us what we needed in terms of being able to run the business. We were able to save almost $20,000 in a year based on some of the changes and decisions that we made. SaaS costs creep up. It's important that you pay attention to those. I'll give you an example. We use Bamboo HR as one of our tools, and we put all of our employee information into Bamboo HR. And because I am a little bit of a cash flow nut, and I look at my expenses and I look at my P&L statement and all of this stuff on a regular basis, I noticed that the payment that came out of my bank account had went, basically from $200 to $300 a month in the span of a month. It literally increased by 50%. So I asked, what happened? Why are we paying so much more? And I realized it was because we had added some of our independent contractors into Bamboo HR. So this gave me an opportunity to make a decision, to decide whether I wanted to pay an additional $100 a month to have those people in there, or whether I wanted to remove them because I didn't want to pay for the additional seats. You can't make those decisions if you don't have your eye on the ball and know what's going on. So it's important that you track these things in a spreadsheet year over year so that you can see how these expenses are influenced by some of the things that you do in your business. Sometimes you're using software that does charge you by the number of seats. So as you grow your team, those costs go up. Sometimes those prices go up because you've added more customers to whatever tool it is you're using. So be mindful and pay attention to those things, because those are expenditures that you need to take into consideration when you are pricing so that you can hit the profit margin goal that you set at the beginning of the year. All right. Number five. Number five is a big one. So I want to tell you right now, the whole next episode is going to be on cash flow because I think it is ridiculously important and most people don't understand it. So I'm going to go into it a little bit of detail right now. And then on the next episode, I'm going to go into it even more. So cash flow management is crucial. You know, they say that the customer is king. It's not. Cash flow is king because when you run out of the money, the bank doesn't care whether you have customers or not. You're done when you run out of money. So managing cash flow is hugely important. In order to properly manage cash flow, you have to forecast the money that comes into your bank account and the money that goes out of your bank account. That's all cash flow is. It's the movement of cash. It's the flow of money in and the flow of money out. You have to be able to predict the timing of when money comes in and when money goes out. That's what the forecasting is all about. If you can predict based on your sales how much money will come into the bank, and you can predict based on your expenses how much money will flow out of the bank and what dates it flows out, then you can manage your cash flow accordingly and you can make really good decisions because you can look into the future and you can see how much cash flow you should have on hand based on the assumptions that you've made. One of the things that's important that you don't forget to take into consideration when you're managing cash flow are your taxes. Because a lot of times when you're collecting money from people, there's taxes included in that money. I'm not just talking about the taxes that you owe at the end of the year. I'm talking about any type of sales tax, HST, GST, provincial or state tax that you collect on a transaction. If you're collecting those taxes, you want to be sure that you are also projecting when you have to pay those taxes out so that you don't confuse it as being cash flow that is relatively available to you when really it is not. When you don't understand the movement of money in your bank account, the amount of money in your bank account can give you a false sense of security. When you understand the inflows and the outflows, you make better decisions. Cash flow projections can also help you to identify potential cash shortages or surpluses, allowing you to make decisions around, either saving more money or making buying decisions. So it's important that when you are managing cash flow, that you use some type of a spreadsheet that allows you to see into the future. Now, if you need a cash flow spreadsheet, I have one. And if you go to my website, lisalarter.com, right below the header image at the top, there is a program that I offer called the Pilot Project. It's a free 10-week course that I send you. It's got all kinds of great stuff about business and money and marketing. And one of the modules is all about cash flow. And in that module, I actually give you an Excel spreadsheet and teach you how to manage your cash flow. So if you're listening to me right now going, well, that's all fine and dandy, but how the heck do I manage it? Go get that spreadsheet. It's hugely, hugely, hugely valuable. Another thing you want to consider when it comes to cash flow are things like your own payment terms and how long you have to pay bills. You also want to take into consideration the seasonality of your business. So let's break that down. One, your own payment terms. Do you expect people to pay up front, or do you give them 30, 60, 90 days to pay you? If you're chasing money because people don't pay you on time, you have a cash flow problem because you're actually being their bank. And that's not a good place to be in. If your customers really respect you, they will pay you on time, but you need to also create clear expectations that payment needs to be rendered for services up front. Otherwise, you are going to be in the business of chasing money. And the longer you have to chase money, the less likely it is you are going to collect it. Now, you may have clients that you have a special relationship with and they've been with you for years and they're always going to pay you 30 to 60 days late. You may make exceptions for those people, but don't make exceptions the rule. The vast majority of your clients, like 99% of them, should pay you upfront, should pay you on time. You should not be chasing money. The money that you have on your accounts receivable list is putting your business at risk. So try to keep your AR number as low as possible. Now let's talk about the flip side. When you have to pay other people money, you want to know what their terms are. And you want to extend payment as long as you can so that you can maximize and optimize your cash flow situation. So I'm going to give you an example. When I used to own my TELUS dealership, I knew that it said I had 30-day terms, but I knew that I could go to 45 without getting in trouble. So I always paid at like day 44. because I knew that I could keep the money in my bank account and I could use it for other things. Sometimes, you can take that money and you can invest it and you can make money on it. So you don't want to pay things faster than you need to pay. Now, it's important that you pay your bills on time. I am not suggesting here that you don't pay your bills on time. I tell all of my independent contractors, if they don't get paid within 24 hours, they should ask me why they didn't, because chances are I didn't see the invoice, because I pay the people that work with me right away. And I do that because to me, it's a huge sign of respect that I value the work that they do for me. So I'm not suggesting that you don't pay people on time, but what I am suggesting is that you game the system. If you have the type of business where you have a lot of cost of goods and your suppliers give you leeway on when to pay, then you want to leverage that and maximize it to your advantage so that you've got working cash flow in your business when you need it. And then the last thing I want to talk about is seasonality. So we talked about that a little bit earlier in terms of, the flower shop example. Another great example would be lawn care. A lawn care company is going to be super busy in the spring and summer months, but in the wintertime, maybe not so much. So when you are managing your cash flow, it's really important that when you're looking at the flow of money, that you don't overestimate those inflows based on seasonality, that you actually carry the inflow estimations through for the whole year so that you can see whether those peak inflows during the seasonal periods are enough to sustain you and carry you. You should know by June, if you're in a summer seasonal business, whether you have enough money to pay your bills till the end of the year, not even till the end of the year, but until spring of next year. Because if there's going to be a real lull in your business for a certain time of the year, you need to gather all that money up front so that you can sustain the business without having to go into debt over the course of the months where your business isn't as busy. Okay, number 6, budget preparation. All right. You can't really do your budgeting until you've done all the other stuff that I talked about, because you need that information to be able to do it. So based on your revenue and your expense projections, your sales and your expenses, you want to create a budget. You want to create a budget and break it down into different categories like sales, marketing, wage cost, operations, administration, travel and entertainment, whatever the categories are in your business, so that you can actually see and budget accordingly. Because your budget needs to align with your business goals. It needs to be a realistic representation. If my business goal is I want a profit margin of 30%, but when I look at all of my expenses, I only have like 10% left over, then I either need to lower my goal of having a 30% margin, or I need to increase my prices, or I need to reduce my costs. Budgeting will help you to know whether or not you are in a good spot or not, and whether or not you need to make changes. It's super important that you ensure that your budget aligns with your business goals and that it's realistic, considering both short-term and long-term needs in your business. It's also a really good idea that you know how much it actually costs to run your business from a people and process perspective so that you can plan accordingly. When I worked in retail, we always had wage costs. We had wage costs. We knew what our wages needed to be. And as managers, we were held accountable for that. If we, exceeded our wage costs, we would get penalized on our bonus, or we would get in trouble because we spent more money than we were allowed to spend. You have to have the discipline to hold yourself accountable to the budgets that you set for your business. Now, that's not to say that you might not be a little bit over 1 month and a little bit under 1 month. We have pay periods where you have 3 pays in 1 month instead of 2. Those things are going to happen, but it's not just getting into the minutia. It's also looking at the big picture of where you land, which is why you should always be looking at your actual performance on a month-to-date basis and a year-to-date basis, so you can see, are you on track for the year? You might have a month that is off, but are you still on track for the year? Because when you have a month that's off, you need to figure out in the months to come, how are you going to make up for that month that was off? That's what is important when you're looking at the long-term view, which leads us to point number 7, monitor and adjust. There is no such thing as a fixed forecast. All right. There are always going to be variables that happen that make things change in your business, which is why you need to monitor and adjust regularly. You need regular weekly and monthly reporting to help you measure where you are at against plan. You wouldn't get in your car and drive if you didn't know how much fuel you had in the tank. Don't operate your business without knowing how much fuel you have in the tank either. And in this case, money is your fuel. And the only way that you can identify deviations or discrepancies and actually take appropriate corrective action is by monitoring and adjusting. And you would be surprised. You have a lot more control than you think you do when you look at things. You, as a business owner, have the capacity to make decisions when it comes to how you price your products and services and how you spend your money. So don't abdicate responsibility to someone else. Don't leave it to your bookkeeper or accountant to tell you what you did. Take control and do what makes the most sense for your business. Use your financial reports, get your profit and losses monthly, have regular weekly reporting, identify key performance indicators to track your progress in your business, and monitor these things on a regular basis. Otherwise, you're just going to end up where you end up and you're not going to have any control. And most of us got into business because we wanted to be able to control our future. We wanted freedom and we wanted to be able to control how much money we make. You cannot control how much money you make if you don't control how much money you spend. And the last thing I want to say about monitoring and adjusting is don't let emotion drive the bus when it comes to your finances. I get it. You have instincts, your intuition. If I feel like I should do all of this, that's all fine. It's all fine and dandy, but don't do it in isolation of the data that can help you to ensure that your intuitive sense is bang on. Don't rely on gut instinct without looking at an actual P&L, because if you're not super intimate with your numbers, there's a really good chance that your gut instinct will be wrong. All right. The next thing you want to do is you want to consider scenario planning. So scenario planning is planning for what might happen. All right. You want to prepare for unexpected events or changes in your business by conducting some of these plans. So consider various what if scenarios. So, what if there's a recession and you lose half your customers? What if there's another supply chain issue and you can't get inventory? What if you lose your biggest customer? Maybe they get bought out, or what if they just decide to stop working with you? Or what if you lose a key team member? What are you going to do? It's important that you think through the contingency plans for these things if you want your business to be healthy and successful. A lot of business owners throw money at problems, and they throw too much money at problems because they haven't done proper scenario planning and they haven't managed the cash flow properly enough to have the funds to make intentional and wise decisions when some of these scenarios come up. So don't let emotions drive decisions in your business. Make decisions with data, not alone on emotion only. All right. When you develop contingency plans, it will actually help you to respond better emotionally because you've actually thought through, well, what if this happens? How will we respond? How will we act? How will we react to all of that? And that's a really good place to be in. All right. Are you feeling overwhelmed? I know I can't see you wave your hand, but if you're feeling overwhelmed, the next piece of advice is probably the best advice I have for you, which is get help. Seek out professional advice. If you are uncertain about financial forecasting and budgeting, hire somebody who has the ability to guide you. But I got to be honest with you. Sometimes accountants and bookkeepers are not the best people to help you do this. And sometimes business coaches lack this type of experience. I have a ton of experience in this because I used to work for a huge corporation and I was responsible for doing the budgeting and the forecasting and the reforecasting and all of this stuff. So I have probably more experience at this stuff than the average person. But if you're going to work with a business coach, you want to understand what they know about these things. Ask them, how do you manage cash flow in your business? Ask them, what type of tools do you use for sales reporting? Ask them, how often do you review your P&L? If they're not asking you for your sales numbers, if they're not asking you to see your P&L, if they're not asking you about the financial health of your business, it's probably because they don't know how to do this. So don't expect somebody who's never done it to help you do it. I'm going to use my business as an example. I am currently looking for a new accounting firm, and I'm looking for an accounting firm that can do very specific things because I operate a business in Canada, I operate a business in the United States, and I live in the United States. I need an accounting firm that has experience with cross-border tax planning and tax filing. And so I don't want just any firm. I want a firm that knows how to do this. Otherwise, I'm going to have to teach them, or I'm going to have to find somebody to teach them, or I'm going to have to pay for the hours that it's going to take them to learn. So don't hire somebody to help you do this stuff if they don't know how to do it. But you are the buyer. So you need to be buyer beware. You need to have a good set of questions that you ask people before you decide whether or not they're the right person to do this work with you. When I do this work with my clients, we work through it together because a lot of times, most of my clients, they don't know how to do this. Nobody's ever shown them. It's not because they're bad. It's because nobody has ever shown them. And so what we do is we do a little bit of show and tell. I'll go through the numbers and I'll tell them what I see and I'll show them what I see. And then over time, after I've taught them and I've shown them and I've pointed to it enough times, I'll ask them to tell me, what do you see? What does this mean? And together, with my help, they learn and they become empowered and they become really, really, really good at the numbers in their business. So don't let the story of I should know this stop you from learning what you need to know to be successful financially in your business. They don't teach you this in school. They don't teach you this in college. They don't teach you this when you apply for a business license. Somebody who's done it needs to help you. Otherwise, you are going to continue to flounder while you try to figure this out yourself. And you can read all the financial books you want. You can listen to the podcast. But the truth is, when you open up a spreadsheet or you open up a P&L and you're trying to understand what it all means, it's like reading a book on trying to learn how to fly. Chances are you're going to crash. So don't be afraid to seek out help when it comes to this. It's one of the most important parts of your business. Don't try to go it alone. I also want to end with a couple of things. So remember, financial forecasting and budgeting, they're iterative processes. You've got to revisit them. You've got to forecast and reforecast, budget and rebudget. It's not a perfect process. It's not a one and done. You don't just set it for the year and walk away and then inspect it at the end of the year to see how you do. It's iterative. You've got to keep at it month over month over month in order to direct your business to get where you want it to go. You need to regularly update your forecast and your budgets based on changes that happen in the business. Last year, we saw some of the largest inflation spikes we've ever seen. If you didn't increase your fees as a result of inflation, then you just lost money on your bottom line. So you have to pay attention to the things that are happening, not only in your business, but in the market so that you can course correct accordingly. When you stay proactive, it allows you to be more adaptable to what is going on. It makes you better prepared to navigate the financial aspects of your business successfully and intentionally. So next episode, I'm going to dive deeper into cash flow so that I can help you better understand how to control cash flow. Instead of feeling like the money in the bank is controlling you, we want you to control the money. And if you want spreadsheets, like I said, go to lisalarter.com. Right below the header image of me on that homepage, there is an opt-in for the pilot project. Get the tools and resources. There are all kinds of spreadsheets in that program, including a cash flow spreadsheet. It will help you get started on doing this work. Your business and your financial future as an entrepreneur is too important for you not to do this. Your future, your retirement, depends on your ability to manage money. So don't leave this as one of those things that you'll get to later. The sooner you take control, the sooner you will be able to actually control the money and the wealth that you're building in your business. Thanks for listening to this episode. And hey, if you listened all this way and you haven't given me a review yet, could you please write a review on Apple Podcast or whatever podcast player you listen to? I would really appreciate it. Thank you.